Welcome to this module on derivatives fundamentals. In this e-learning module, we're going to start by taking a look at the key definition for derivatives. Now, derivatives are used for hedging and trading across all of the main asset classes. And the key players in the market that you might be working for would be investment banks, corporates, asset managers, and hedge funds. So once we've talked about the main definition of a derivative, we'll move on to the more basic derivatives, and that's forwards and futures. We'll see how forwards are used in practice and how they're calculated, and we'll then contrast them with futures. When we talk about futures, we'll see how calculations are done for calculating the profit and loss for futures positions, and we'll spend some time taking a look at how clearing works in the market. Once we've done forwards and futures, we'll move on to options. We'll start by giving some basic definitions around calls and puts, and then we will show you how to do payoff profiles for buying calls and puts and also selling calls and puts. Now, there's a lot of terminology in this market, so we'll explain what is meant by in the money, at the money, and out of the money, and we'll also take some time to look at time value and intrinsic value and explain how they are calculated. Once we've got the main definitions out of the way and we know what the payoff profiles are for the four basic options, we will then take a look at hedging using derivatives. A lot of market participants actually will use derivatives to manage their underlying risk, whether that's in the equity market or in the commodity market. So we will see how you can do that using both calls and puts. We'll also look at using combinations of calls and puts. So for example, creating a collar hedge and perhaps even a zero cost collar. Once we've done the hedging session, we will move on to trading with options. We will see quite a few different types of trades that can be placed on the various markets. So we'll look at straddles, strangles, butterflies, call spreads, and risk reversals, all different ways of tailoring your view to a trade for a particular market. Once we've done those relatively straightforward trades, we will move on to the options sensitivities. So when we look at an option, what are the key drivers of the price and how is the price sensitive to those key drivers? This is what we talk about when we talk about the Greeks. This is delta, gamma, vega, theta, rho, for example. And we'll spend quite a bit of time talking about how we can manage the risk of running an option portfolio by analyzing those Greeks and using those Greeks to manage the portfolio. Good luck. Thank you.